Consumer Bankers Association is pleased to welcome you to today's webinar, An Agile Approach for Resilient Collections, presented by Genpact. My name is Jennifer, and it's my pleasure to facilitate. We're happy all of you have joined. Please note we are recording, and we muted all participant lines. If you have any trouble, please email cba@compartners.com or send us a message in the chat box. If you're listening over the phone, please press *0 for help. This presentation will last up to 60 minutes and does include a time for question and answers at the end. You may submit a question at any time by clicking it into the chat box in the lower left corner of your screen, and then do be sure to click the send button. I'd like to direct your attention to the links box, also on the left side of your screen, where there are resources for you to view, save, or print. Simply click on the link of your choice, and a separate window will open. This will not interfere with your viewing of the program. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It's now my pleasure to introduce the speakers for today. Andy Estacio is the Banking Sourcing Research Director at NelsonHall, where he has global responsibility for retail and commercial banking, BPS, capital markets, BPS, and RPA, AI, and FinTech services in banking, including consulting, design and deploy, and operation support. In this key role, Andy assists both buy-side and vendor organizations in assessing opportunities and supplier capability across banking services, including in the areas of core banking, payments, mortgages and loans, securities processing. In these domains, Andy covers professional services, hosting, and BPS. Jason Osborne leads Genpact's global consumer banking practice. In this role, Jason is responsible for the establishing and maintaining of Genpact's consumer banking strategy, its business results, and the selection and management of the digital transformation services and offerings. Jason brings significant leadership experience across consumer financial organizations. He recently joined Genpact from Citibank, where he was most recently the head of strategic partnerships for Citi's global retail bank. Vikram Madidar is an entrepreneur, innovator, and advisor. At Genpact, he leads the digital transformation business, which drives large-scale business transformation using artificial intelligence, analytics, intelligent automation, and cloud for Genpact clients, which include a quarter of the global Fortune 500. Welcome to all three of you, and Andy, I'll turn it over to you to get us started.
Thank you very much, Jennifer. I appreciate it. Today I'd like to share some research and insights into just how large a surge in defaulted loans and therefore collections activities will grow over the next few quarters or at most the next 3 years. My research at NelsonHall shows that the scale and scope of the impending loan delinquency surge will require a massive increase in the scale of collections in order to effectively respond to the emerging delinquency surge. We currently have headlines that indicate delinquencies are going to surge, and these headlines include things like the Department of Labor in the United States announcing that the total number of first-time unemployment claims in the U.S. for the 6 weeks ended April 30th surged to 30 million claims. And up until yesterday, that had surged further to 36 million, and today another 2.5 million, almost 2.5 million. In addition, J.P. Morgan has increased its loan loss reserves by $6.8 billion in the first quarter of 2020. That's as opposed to a year-end 2019 reserves of $13.1 billion. That's a 52% addition to loan loss reserves in one quarter. The IMF on April 14th predicted the global economy will decline 3% in 2020, and that's a downward revision of 6.3% from their January prediction. To contrast that, the global financial crisis produced a negative 0.1% shrinkage in the global economy. That makes this crisis much larger in negative economic consequences. Much larger means on the order of 63 times larger. But these claims are not contextualized for our purposes to identify whether this will produce a major impact on collections or not. So let's try to get a handle on the level of delinquencies we might expect based on historical performance. Default levels are going to be based on the size of loan portfolios times the increased levels of default. So, up until this year, loan portfolios have been growing. The New York Fed reported as of year-end 2019 that consumer debt is up 26.8% higher than the trough, which was reached in second quarter of 2013. So we're looking at loan portfolios which are 26.8% larger than 7 years ago. Meanwhile, delinquencies are at a cyclical low based on the most recent reporting. So again, according to the Federal Reserve Bank, the delinquency rate on consumer loans at commercial banks in the U.S. has varied over the cycle. Those default delinquency rates were at 1.87% in the second quarter of 2007, which was at the height of the economic cycle just prior to the crisis. That delinquency rate spiked up 3 years later and reached a high at the height of the crisis in the first quarter of 2010 of 7.4%, and since then has declined to 1.44% by fourth quarter of 2019. So if this pattern repeats itself, default rates will climb by 5.1 times the current levels. The ramp up in defaults will begin rapidly starting now. It has already begun. This means that the volume of defaults and therefore the collection work should climb to 6.7 times the level we faced as recently as 2013. And that's because 26.8% larger portfolios times 5.1 times higher default rates equals 6.7 times higher default levels. So now we have to ask, since lenders shrank their collections staff over the past 7 years, and those 7.5 years had declining default rates, now can lenders scale up operations to meet the surge in collections work? NelsonHall recently conducted a survey of 200 banking executives to understand the impact of COVID-19 on bankers' operational delivery over the next year. And this survey had a number of findings. 3 key findings for today is that the bank executives expect, first, operational transformation activity is forecast to be reduced by 10% over the next year. Digital IT transformation activity is expected to be reduced by 2% over the next year. And operational budgets are expected to be reduced by 8% over the next year. This data indicates that banks will be resource constrained in addressing the collections surge. So how can lenders manage the increased requirements for data management and maximize recoveries? So I'd like to turn now to our panelists with some questions for them on how to address these challenges. So the first question, Jason, hi. Based on industry experience, we can expect a ramp up of collections work over the next 3 years to approximately 7 times the current level of collections management. The ramp up will begin rapidly starting in the second half of 2020. So the question is, how can banks and financial institutions prepare to deal with this inevitable surge? Jason?
Hi, Andy. Thank you. And first of all, let me say thank you to the Consumer Bankers Association, as well as to you, Andy and Vikram, for the amazing work that's really come into this webinar and the astounding research of what you just presented, Andy. In terms of the question, the first thing I'd say is there's no silver bullet. The solution that banks have to come up with is really going to be a combination of factors. There are all kinds of unique challenges facing banks, from higher delinquencies on the demand side to lower numbers of FTE on the supply side as a result of social distancing and office closures, which has really forced a new work-from-home model that the world wasn't yet prepared for. At Genpact, we're recommending an approach. It's really a multi-pronged approach, and I'm going to quickly run through 6 points to address that approach. First of all, banks have got to get ahead of the curve. To your point, with as many as 38 million unemployment claims over the past 8 weeks, this equates to more than all of the jobs created in the U.S. over the past 4 years. It's inevitable that there's going to be a massive spike in delinquencies, and if banks don't act now, it's going to be hard to play catch up. We've been working with many of the top global banks to start the recruitment, the hiring, the training from a work-from-home capacity now, recognizing that we'll start to see a significant impact, which has already started, to your point, Andy, but we probably aren't going to see the real impact or the peak, at least until Q3, and potentially only going to go up from there. The second point I'd make is the ability to leverage new forms of data. Another way to get ahead of the curve is to identify and remediate high-risk customers before they even go into delinquency. Banks can do this through customized strategies that leverage internal data, alternative data, and machine learning to arrive at an optimal combination to proactively address hardship plans. Banks have to get comfortable with an ability to rapidly analyze data, including new forms of data and alternative data streams to drive agility in the current process. As an example, we've recently helped a U.S. cards issuer reduce their losses by $2 million through early identification of treatment of high-risk customers. But the way we did this was pretty unique. We did this by taking customer service notes, applying an AI logic, and identifying those customers which we thought would be high risk based on the notes within the customer service platform. This data mining exercise was a good example of how leveraging data and different sources of data can drive new treatment strategies. The third point that I would make is around regulatory changes. We already know that the CFPB, or the Consumer Financial Protection Bureau, has recently published new contact policies. The governments across the world are going to monitor collections practices, and it's best to work with and coordinate with third parties and regulators to understand those changes before they take hold, and being able to quickly adapt to those new changes is going to be imperative from a collection success perspective. The fourth point I'd make is to double down around digital capabilities. Voice alone is going to be a huge opportunity cost if banks don't combine that with omni-channel capabilities for customer contact, payments solutions, as well as SMS and email solutions beyond just voice. For example, banks today are leveraging email with built-in payment solutions, so a customer doesn't even have to log into the mobile app or go online or write a check. Banks have SMS strategies, and often those SMS strategies are combined with email strategies. Websites are another example. How is the bank's website going to change? Does it display messages around repayment options as soon as customers log in, or are they sticking with the traditional method of login to be able to then go make a payment? There really have to be new ways and solutions, including negotiating payment functionalities through chatbot. The question here is, how are banks going to leverage and remind customers, even through mobile app and other early stages of delinquency, in non-voice or traditional channels that have to be leveraged? Point number 5 is around collections isn't just for collectors in this environment. It's got to be a cross-functional effort. Clearly, there's a partnership that needs to work with credit and risk, but what about digital teams? What about client experience teams? What about customer service? How do you bring the entire organization together to solve for these unique challenges? And I really challenge banks to take a look across the organization. It's going to be more important than ever to have a coordinated approach across the entire franchise that spans all functions of the bank to solve for the challenges that you spoke about. This isn't just going to be a standalone collections activity, but the approach is going to have to drive an entire bank effort. And by the way, I think that would actually have a positive impact on client experience along the way. The sixth and final point that I would make is free up staff to focus on what matters most. It may not seem intuitive, but banks really should invest in automating manual back office processes in order to be able to free up time to focus on more collections activities. For example, we've been leveraging robotics process automation to help banks automate an increasing backlog of cases of loan forbearance and extensions related to the CARES program. This has freed up valuable time for back office employees to actually now focus on more front office activities related to collections. So I know that was a lot to go through very quickly, Andy, but the 6 points that I really wanted to get across are, number one, get ahead of the curve. Number two, find new ways to leverage data. Number three, anticipate regulatory changes. Number four, double down on digital capabilities. Number five, engage the entire organization. And then finally, use automation to free up time and focus on what matters most. Thank you.
Thank you, Jason. That's very insightful. I appreciate it. If we move to the next question, Vikram, before this pandemic, banks were already investing in digital capabilities to make collections a more automated function, increase the accuracy of their credit risk prediction, perfect their contact strategies, and try to prevent defaults. So speak to us about how they can put their existing digital and analytical capabilities to work in new ways and help better manage this expected surge in delinquencies and also address immediate and long-term challenges.
Thanks, Andy. First of all, thanks to the audience for joining us on this webinar, and Andy and Jason, great to be in this dialogue. Also, thanks the Consumer Banking Association for hosting us. So going back to your question, I think it's a fantastic question, and we hear this all the time. That I've already invested in analytics capabilities and digital capabilities. So what's new? What should I be doing differently? And I'd like to mention three different aspects here that are very different as compared to what we have all planned for pre-pandemic. Number one, while the analytics models and the machine learning models that may have been developed before worked in terms of refining the customer segmentation and identifying the right customer behavior. But customer behavior has changed now. The data has changed now. As Jason was mentioning earlier, we really need to understand the customer behavior from a different lens, through the lens of alternate data sets, through the lens of data sets that already exist in four walls of the banks, but that have not been tapped into before. Because at the end of the day, the idea here is to really understand the patterns, appropriately narrow down on what would be the best approach to reaching out to the customers, and where are you going to get the most optimal response in terms of the customer behavior. And what we have found here is it's all about experimentation at a very rapid pace, because we are gathering the data as we are launching different strategies to reach out to the customers through different channels in the market. And as it's almost like flying the plane while you're building it, and your strategies need to change pretty much on a weekly basis based on the insights that you're getting from the market. And to that end, augmenting the teams that are already doing the existing sort of analytics and driving machine learning models with right amount of expertise around machine learning and AI has helped and will continue to help many of the customers that we work with. So that's number one. Second, the most important piece here is understanding the customer, as I mentioned. But unlike any other crisis, here it's not just the customer is not just impacted economically, but socially as well as from health perspective. And what that really requires is empathetic response. And while it's a term that all of us associate with and understand, but it's very hard to measure. So really figuring out what will be those proxy metrics for empathetic response, and how are you going to weave that into the outreach? That's super critical. And we have been working with a variety of different customers, banks, our customers, banks, to help them figure out how these metrics need to be designed, need to be institutionalized, using, again, certain set of data sets that you already have, such as, customer notes that Jason was alluding to earlier, and text mining on those notes, and also looking at, marrying that with the data sets that you're gathering around customer behavior. The third aspect here is, omni-channel outreach. And more importantly, it's about the process agility. As to once you start experimenting and understanding the data sets, identifying the patterns, properly segmenting your customer base. And the segmentation will continue to change based on how much you learn and how the customers respond. But having that agility to switch across different digital channels, whether it is an embedded email, whether it is a mobile-based outreach, or what have you, most organizations are unprepared for that process agility. And being a digital guy, I can tell you, process-first approach here is very, very effective. So in summary, there are three things. Number one, augmenting the existing analytics teams and machine learning teams with the right skill sets around machine learning, etc., and experimenting at a very rapid pace, what we call rapid response. Number two is around designing the right empathetic response. And number three, creating the process agility to switch across outreach channels will definitely, we think, be a winning formula.
Thank you very much, Vikram. Very interesting about how to use artificial intelligence to coordinate an effective response. Thank you. Jason, banks have these massive issues. Some have been seen before, some unheard of. Challenges on one hand, and financially and emotionally fragile customers on the other hand. How do you think banks will create a balance between easing financial pressure on customers and improving recovery to sustain themselves in this recessionary environment?
Yeah, thanks, Andy. That is a great question, and in fact, a challenging one indeed. I want to go back and touch on something that Vikram was talking about, specific to an empathetic response and what it actually looks like. So the challenging question here is that banks are going to have to adapt very quickly. COVID-19 has had a profound effect on the global economy, and an even more so profound effect on millions and millions of people's personal financial situations in a way that the global economy has just never experienced before. Even going back to 2008, 2009, you would see, obviously in pockets, but not the entire global economy shutting down for a month, 2 months on end. So the challenge that banks really face here is, what's the reputational risk that they face if this isn't handled appropriately? And frankly, I think banks have an obligation and really a responsibility to build empathy systemically into their operations, to find the right balance between easing financial pressure and improving recoveries, given the situation that the world is in. And so how do you do that effectively? When you take a step back and you look at the end-to-end process, there are actually a lot of changes that you can do to drive empathy systemically throughout operations. For example, take a look at your hiring profiles. Take a look at your interview questions. Have you changed interview questions throughout the hiring process for collectors to include focused questions on empathy? What about training, both new hire training as well as existing agent training? How are banks adjusting to baking this training in a remote or a virtual environment? I've even heard of some banks that have gone out and hired psychologists to help them think through and build empathy into collectors' scorecards and think about how do you build it into the training as well. Another example beyond training in the process is how do you train empathy with the use of speech analytics? We've actually taken a look at this and helped a few banks with speech analytic capabilities to help analyze tone of voice, what words are said, when they're said, how they're said. We've also been working on real-time speech analytics. So the first set of speech analytics I was talking about happens after the fact. Well, through some of the solutions that Vikram and team have been working on, we think that there's an opportunity to potentially implement real-time speech analytics through conversational AI to prompt the collector with the right payment plan, matching the customer needs and the appropriate verbiage to maximize that collections while being more empathetic in the process. Finally, I think banks have the big opportunity to treat customers through better channel preference models based on customer data and behavior. So if you know someone's more likely to respond via text, why are you calling them? Is there an opportunity to build a purely digital process end-to-end that may have the same result? And by the way, again, improve client experience along the way. I think data can help predict this and limit the interruption of daily phone contact. By applying advanced analytics, I think, and machine learning, banks can identify the most promising contact channels based on customer preference, while also developing digital channels to define an innovative way, along with regulatory and compliant contact strategies as well. The same digital channels that could be used to build awareness can also be leveraged for seamless payment options as well. So I think leveraging these solutions combined with a systemic approach to training around empathy, leveraging data, contact channel preferences, can help banks find the right balance between easing financial pressure, while at the same point in time, Andy, improving recoveries.
Thank you very much. That's very interesting on how to build personalized treatment strategies and drive empathy into the operations. Appreciate that, Jason. Vikram, Jason mentioned that the banks must develop hyper-personalized treatment strategies while also leveraging data and automation and driving empathy systemically into their operations. We all know that banks are already working on these in bits and pieces, somewhat catch as catch can across the industry. But now it's time to step on the gas. And how would you advise them the banks to go about doing this?
Yeah, I know it's a very very profound question, actually. There are three levers or three approaches that I would recommend that we are implementing ourselves or have seen to be successful. See, one big thing that we always talk about is use alternate data or use machine learning and what have you. But most of the time, what we've realized is that the crux of success here is actually the right data management. Investing in robust data layer to manage, govern, and wrangle the data appropriately is super critical. Because in these times, there are two things that are happening. One is that you are gathering most valuable data about your customer that you've never gathered before. But also you're mashing it up with prior data sets and other alternate data sets that you have, time series data, in some cases it is point-in-time data, etc. And if you don't appropriately mash it, it's almost garbage in, garbage out. So managing data appropriately and investing in that data layer is critical. Now I appreciate that, Andy, you mentioned earlier that technology spend is going down. The purse strings are going to be much tighter than ever before. But there are certain critical capabilities if you were to really think about. So what should I hold, what should I fold, and what should I double down on? This is one particular area. Data management is what I would say it's time to double down on. The second piece, I talked about process agility earlier, and Jason was sort of describing how we are helping figure out, empathetic response using analytics, speech analytics, and other methods. But end of the day, to complete the life cycle and make sure that it's all compliant from the regulatory standpoint, controls design becomes very critical. Using several digital tools and several different analytical techniques and machine learning models, it's super critical to have a very strong controls framework in place. Otherwise, obviously, reporting becomes a nightmare. But more importantly, I think just to execute the strategies effectively, controls play a huge role, and especially when you're in a hurry to get to the response, controls may get forgotten, and it's not, it's a very critical piece that cannot be forgotten. The third thing here is test before you harden. It's many banks have been on the journey for achieving different business goals on creating large, data layers, whether it is in cloud or large, data warehouses, global warehouses, etc. But those journeys become very long, journeys, and the idea here is no need to harden any of the data pipes or any of the techniques until you test them in the market, until those strategies are proven, and keep an eye on where those processes can be actually automated, because many times data capture, data processing, data gathering, a lot of those processes actually can be automated. So use as much as automation as possible, but test them. And also keep an eye that which one of these strategies are you going to harvest and build them, institutionalize them as you come out of this crisis and build sort of, the foundation for the future. So just to sum it up, the number one, focus on data management and investing in a robust data layer is critical. Number two, designing right controls, both in your digital tools as well as processes, to complete the life cycle appropriately and maintain the regulatory response. And number three, test before you harden. Those are the three things that I would recommend.
Thank you, Vikram. That's an excellent set of practices and a framework for managing data to improve performance and improve regulatory compliance. I think we all know that Agile collections are essential for banks to improve loan recoveries, but a very important part of making collections truly Agile is managing the change, pulling in the right partners, change management. How do you think banks should address these issues to make their collections operations agile? Perhaps, Jason, you could address
sure.
that.
Absolutely. So, Andy, I'll take a stab here, and then I'll pass it over to Vikram as well, because I think he'll have some good thoughts on it. So I'll answer it probably from more of a operational practitioner perspective, and then I'm sure Vikram can add to that from more of a digital technical perspective. But here's what I'd say is all banks have change management, and a lot of times those change management are centered around more technical aspects. And so the question is, really, how do you keep focused on the evolving needs of people to navigate this new way of working in order to be truly agile? I think banks over the last month, frankly, not banks, all organizations over the last couple of months have been forced to become agile. But the question, again, really is, how do you not just let this happen to you, but you actually are proactive and think through, what does agility mean? So, for example, banks, along with their partners, should be able to develop a framework for communication that includes defining the best approach to maintain focus on execution, collaboration, and communication in a remote work environment. So now that a lot of companies have been frankly, working remotely for the last couple of months, how do you develop and harden that collaboration and communication in this environment in ways that haven't been done before? For example, at Genpact, we've developed a proprietary tool. It's called a Unified Intelligent Operations Platform. And it has over 100 metrics to provide real-time monitoring of service levels, of KPIs, management, and basically allows folks to keep a pulse of the operational health. This also helps supervisors monitor agents who are working remotely and their functionalities that also enable virtual daily huddles, tracking issues, agent performance, benchmarks, etc. Another thing I'd say around this Agile approach is really around employees, right? So how do you understand how employees are feeling and staying motivated, and how are they being impacted by, working at home when the dog's barking and the kids are screaming, and trying to figure out how do you actually do things like collections in that environment. So I think banks and their partners, they've got to figure out and increase ways to gather employee feedback and escalate issues or concerns in this virtual environment. So a feedback loop, or actually not having a feedback loop, can slow change adoption immensely or even cause change to fail. So we've actually deployed an AI chatbot known as Amber. And Amber is actually a pretty fascinating use case. So rather than having a static kind of VOE that happens once a year, Amber actually monitors the voice of the employee real time, asks questions, employees provide feedback real time, and that feedback is then generated back to managers, leadership, really across the organization to figure out what are the pulse of the people that have to live and work through what's happening in a real time basis. I've personally used Amber myself, and again, find it fascinating that you're actually able to now collect real time feedback throughout the organization to understand employee sentiment and help drive employee engagement at the same point in time. So that's another example of being agile. Finally, from a partner perspective, I would call it the Tom Brady effect whenever looking for a good partner. And so for those of you who may not know, Tom Brady, I know there's a lot of folks on the phone that are from outside the U.S. Tom Brady is a quarterback, formerly of the New England Patriots. And the rumor is that pretty much no matter who you surround Tom Brady with, he's going to figure out a way to be successful because he elevates everyone's status to his. So he's really the ultimate team player, but at the same point in time, he's not in it for himself. He makes everyone around him better. The question is really from a partner perspective, how can you find a partner that has the same Tom Brady effect? So someone who's not only going to provide operational excellence and agility within its walls, but how does that partner also help drive value back to the proprietary organization or the outsourcing organization to the business as well? And so I think it's important, or it's absolutely important and pertinent to be able to find those Tom Brady-like partners that, again, aren't only in it for themselves, but they're going to be able to challenge the actual outsourcing organization to be better itself. Vikram, I'll hand it over to you to answer maybe a bit more of a technical perspective here as well.
Yeah, certainly, Jason. I think you covered some really interesting points here. From technology standpoint, right? The Amber example is a fantastic example. I just want to sort of, elaborate on that a little bit. When Jason mentioned that, we internally use a chatbot type of, system that polls our employees on a regular basis, on a pretty much rolling basis. We're talking about 100,000 employees. And the key thing here is the response in these times is 5 times more than any other times. And what that tells you is really that it's not about the technology, it's the times, the amount of uncertainty that's out there. Actually, people are looking to engage. And what I would do is, I would extend that type of technology even to the customers. If you reach out to the customers appropriately, using the right mechanism, it's not about the technology adoption. It's about reaching them at the right moment and gathering the right information. And obviously, you have to close the loop. So devising strategies at the back of it quickly and reaching out to the customers quickly is very critical. And by the way, we've been doing that internally for our employees as well as some of our own customers, and it has been very effective. The feedback has been super positive. So I would highly recommend something like that. Then the second piece here is also choosing the right technology sets. It's not about how sophisticated the technology is, but it's about how suitable the technology is and how quickly can it allow your customers to interact with you. Some of the banks that we've been talking to have been very effectively using mobile interface, while in some of the markets, they've not seen as much adoption in the past. However, in these times, I would not ignore those channels, particularly mobile, text messaging based channels, to reach out to your customers because some of these channels are easy to implement, but also customers are much easier in terms of interacting. It is much easier for customers to interact back with the banks. So those are a couple of things that I would highlight here.
Okay. Well, thank you, Jason and Vikram. Your insights are very valuable into this rapidly changing area. I'd also like to thank our hosts at the Consumer Bankers Association. But I know that the audience has found your discussion very valuable, and I know that because we have quite a list of questions, not all of which we'll be able to answer today, but at least we'll be able to begin on them. And while the three of us have been speaking, Jennifer from the Consumer Bankers Association has been collecting the questions, and I'd like to turn it over for Jennifer to share with us some of the audience questions and have Jason and Vikram take a stab at answering those questions. Jennifer?
Wonderful. Thank you. And as a reminder, if you have questions for our presenters, simply type those into the chat box in the lower left corner of your screen, and then be sure to click the send button. So our first question that came in is for you, Vikram, and it asks, in the wake of overwhelming delinquencies, we can get blindsided and consider a potential low-risk customer as delinquent. What kind of data models can help avoid the situation?
That's a great question, and it all goes back to what data sets you are using to truly identify, the risk levels for a customer. In the past, most of the sort of banks used, customers' cash flow related metrics or their balance sheet related metrics, and maybe their payment history in the past. But now, what we are looking at is adding new data sets, even around their balance sheets or their cash flow, around what has been the pattern with regard to their cash flow, or what has been the prior pattern from the alternate data sources, whether it is social media or other data sources that you can gather about a customer. So going from a handful of metrics to more metrics and refining them to come up with new stratification would be super helpful, so that you don't end up picking a low-risk customer as a delinquent or potential delinquent customer. That's what I would recommend.
Okay, and Jason, this next one is for you. We are running short of agents. Work from home is not an option, and our collections agencies are also in a similar situation. What's the best way to ramp up collections when maintaining business continuity itself? It's a day-to-day challenge.
Oh, yeah, sure, Jennifer. Thank you. And thank you for whoever submitted the question. The first thing I would say is you mentioned work from home is not an option, and I would really challenge that and encourage you to challenge the organization as well. This model we've seen implemented all over the world, and one of the things that we've seen and noticed is our banking partners that were the fastest to implement work from home are really the ones who are coming out on top, and they are ahead of the curve. And I think that if you're in an organization or a region that is not embracing work from home, I don't think this is going to be a short-term solution. I think work from home is going to be a longer-term, more permanent solution once we get back to the new norm, whatever the new norm is. So I would really challenge the organizational thought and leadership around work from home. But let's assume for a second that work from home truly is not an option. Then I would say really you have to manage parallel paths here. The first thing I would say is solidify your existing resources. So you mentioned, that you're running short of agents and work from home is not an option. So how do you solidify exactly what's happening within your current scenario? How do you implement some of these policies and practices like we spoke about to be more agile, to ensure that training is pushed out to everyone in a virtual and a remote manner? Implement tools that allow for real-time coaching feedback and get the best and most productivity leveraging these types of tools with your existing resources. In parallel, I would say really start to think about the recruitment hiring process now and understand that there are going to be changes in that recruitment, hiring, and training process going forward. So if work from home is not an option, what is the plan to come back in the office? How are you going to prepare for social distancing in the office? How are you going to train people with social distancing in the office? How are you going to hire and recruit differently in order to be able to find people who are willing to go into the office? So I think that there has to be a parallel path and a parallel track there as well to really have a solidified project management, a very disciplined approach to uncover every stone in terms of the way that you used to operate versus the way that you need to operate going forward in this new environment that we have to work in. So in summary, I would challenge the work from home. Why not? If most banks across the globe are doing it, what's preventing the same here? And then two, if it truly is not an option, manage parallel paths, solidify existing resources while starting a parallel recruitment, training, and hiring process, recognizing it's going to be different than the way you've done it in the past. Hopefully, Jennifer, that answers your question.
Yes, thank you. And I'll throw this out to anyone who would like to answer. Are there reputational challenges which are now emerging for lenders who are trying to maintain repayment schedules with consumers who are trying to manage a way through the current situation? Are there empathetic approaches that can be tailored to an individual to differentiate between can't pay versus won't pay?
Yeah, sure. It's Jason. I'll pick that one up, and then Vikram, Andy, I'll also feel free to chime in. So from a reputational risk, the answer is 100% yes. Banks face a significant reputational risk if we treat our clients, our end user customers who have entrusted us with their money and their credit cards and their financial lives and don't treat them in an empathetic way. And as I mentioned before, I think banks have a really responsibility and an obligation to figure out new ways of managing this process given the environment that we're in. As far as how to do that and some of the strategies, Andy mentioned, as well as what I spoke about a little bit earlier around hyper-personalized strategies. So hardship programs are going to have to be hyper-personalized, and a lot of this can be done leveraging some of the data that Vikram was talking about and referring to earlier. But if you have someone who can't pay, well, what can they pay? What's the next best offer? What's the next best action? And it's got to be beyond just deferring a payment for 3 months. It may be something around paying, a minimum, whatever they possibly can, but working with that individual to be able to find the right solution, especially if that individual has been impacted by COVID. And so I think that the combination of being able to leverage data, being able to leverage alternate data, like Vikram was talking about, and creating specific hardship solutions are going to be the key to avoiding that reputational risk. Vikram or Andy, anything you'd add?
Yeah, this is Vikram. I'll add one or two additional points there. I completely agree with you, Jason, there. I think the key here is to get ahead of the customer before they get into distress and provide them options, before it becomes a downward spiral. That's the key. And obviously predicting it is important, but also providing certain options around, where they can create their own self-cure plan, if you may. And in some cases, instead of dialing in and engaging the customer, which is a traditional approach, it could also be that providing them more online tools so that they can decide what's their minimal optimal is, but continuously engaging them so that they can decide and stay connected. That definitely would be one of the empathetic responses. Also a good way of digitally engaging with the customer, I would say, and it also provides a very good experience if the customer is engaging through that channel.
Hey, Vikram, I want to add to something that you mentioned there that you spoke a little bit about earlier, which is omni-channel, right? So, we saw some banks really struggle with service levels. Actually, all banks really struggle with service levels going back to whenever the COVID crisis first hit, because people were calling for obvious reasons. Some banks are still struggling with service levels. And so that omni-channel approach around your point, Vikram, to, what are the text solutions? What are the chatbot solutions? What are even simple solutions like within the IVR providing a callback solution? Because if I wait in the IVR or I wait for a customer service rep for 2 hours to talk about a hardship program, it feels a lot different than if I schedule someone to call me back in 2 hours, which feels more like 10 minutes. So really accelerating that omni-channel approach with the digital solutions combined with the personalized hardship programs, I think, again, is really going to be key to managing that reputational risk that banks are going to be facing.
Yeah, certainly agree with that, Jason. We're very critical on meeting the customer where they're at, and obviously it's not easy to gauge at such a huge scale, but creating certain fine-tuned micro models to reach them and engage them through different channels would be very effective in these conditions.
We did have another question come in asking, to what extent do you believe government interventions like the stimulus, enhanced unemployment, PPE, will mitigate the proposed surge?
Sure, I'll pick that one up. And Andy, I think you'll have some great perspective on this based on the research that you've provided as well. I would say it will have a positive impact. There's no doubt whatsoever that the way that governments are treating the situation and helping citizens across the world be able to manage this is without a doubt going to have a positive impact. What I would say that the question is, how much of a mitigant will that have? So whenever you think about what Andy was talking around, some of the percentages and some of the spikes that we've seen are unlike anything that we've seen before. So will it have a mitigant or will it have a positive impact? Absolutely. Will it completely control or curb the rise in delinquencies that we're going to see? Absolutely not. And so it's going to be somewhere in the middle. It will have a positive impact without a doubt, but will it completely curb it? The answer is no. And so the question is, how do you not necessarily prepare for the worst case and hope for the best case, but I think actually preparing for the worst case and being able to respond to worst case scenario is something that should be prepared, should be planned for. Because otherwise, in this economic environment, it's really difficult to be able to say, is this going to cause 3, 6, 9 months of hardship? I just don't think that there's enough detail to be able to answer that. So in short summary, it will have a positive impact, but it's not going to completely mitigate the curve.
Yeah, to some extent, what the government programs do is mitigate a spike in cases at the beginning but it has the effect of spreading it out over a longer period of time. So it, mitigates a crisis today, but it comes at the expense of having a longer series of workouts. And to the extent the bank can customize its engagement with customers and find appropriate accommodation, they can solve or resolve cases, and that puts it, out of the work bucket, if you will. The government gives you more time to deal with it, but you still have to be effective at dealing with it to reduce your overall workload and to achieve higher customer satisfaction. Okay, thank you. Jennifer?
Great. Anything else you'd like to add before we go ahead and wrap up?
Not here. Thank you.
Okay. With that, we will go ahead and conclude. We did record the session, and we'll make it available within 3 to 5 business days. You may access the recorded archive by using the same login information you used for today's live webinar. Feel free to share the recording link with your colleagues. On behalf of the Consumer Bankers Association, thank you to our speakers, and of course, all of today's participants. Have a wonderful day, and you may now disconnect.